Hello, Business Finance 500D MBA summer session. This is Professor Hassey. It's our week 3 course lecture video entitled Risk and Return, leading to assignment number 1, which is posted to Blackboard, and that work on what is finance heading is due on Sunday, June 26 to Blackboard. But again, if you need extra time, you can get an extension on that. Subsequently, next week, we have another assignment which is on the material of chapter 5 and present time value of money, and also some risk and return and bond valuation. We'll be talking about that next week, and that'll be our next assignment due. That'll be due July 3rd. But this week our topic is risk and return. And let me just, before we get into the discussion of this week, today's date is Wednesday, June 22nd. And I want to make sure that all of you are doing well and getting the information you need from Blackboard. If you have any questions or concerns, be sure to let me know, either through the discussion forum or through email. So let's take a look at where we are right now in our class. So here's our Blackboard site, which I hope you're getting used to and getting used to the structure of our online course. Again, if you have any, whenever I send an email out or instructions, it's always posted to the course announcement area when I update videos or update lecture material. The Zoom and YouTube links is one stop where you find all the information relative to our class as far as videos is concerned. There it is right there. And then we have our student discussion forum, where here is an area that you can ask me questions. If you have any questions about the course and wanted to give me any feedback, there it is right there under questions and comments. And then we have this week assignments. We have the first assignment, which we're going to talk about in just a minute, which is due this Sunday. It's I gave you 2 files. It's both the same work. One is a Word doc file. Another is a PDF file. Please download those, do the work. If you require an additional Excel or spreadsheet file, please do so, and then post it to this file folder at the end when you get your work done. So basically, you click on this file heading, and up comes an upload file where you go to browse local files, and you download or pick the files that you have for your work files, hit open, and then they'll upload to the Blackboard, and then I can grade them and then return them back to you in your grade center. But make sure you hit submit after you upload your files. So that's assignment 1, and this is where all our assessed work will be throughout our course. And then we get into week number 3 this week, risk and return, and every week we have learning assignments. This lecture video, chapter 6 is the related text chapter. We have a spreadsheet, which I'm going to be going over in this lecture video. And then you have your graded work this week, assignment number 1, what is finance? And it's due on Sunday. So that's our schedule. That's where we are. And if you want to go back, look at prior work, there's week 1, there's week 2, and as we go forward into week 4, and so on in the class. So I hope you're finding everything okay and you're getting comfortable with our format. And again, if you're not, be sure to let me know. Here's our assignment number 1 for the file this week. It's a combination of short answer, multiple choice, and some calculations. So again, if you have questions going through it, just download it and answer the questions. Basic definitions of finance and why we're taking this course called business finance or corporate finance. And some basic definitions of finance, basic definition of financial management. Some basic calculations about present value, time value of money, which was our discussion last week. What is the future value, present value of cash flows going forward in the future, and a quick question about amortized loan or an interest payment on a loan. And then a real world application of time value of money. I want you to select something from your own personal, professional, or personal business life, and give me an example of the present or future value and explain it. Explain how these values are used in your example, and explain why you use these in your own personal or professional life. You should basically write about a page on this, but I want a real world application of the time value of money, of what we're talking about the last couple of weeks. So that's assignment number one, a combination of some writing, some calculating, some definition work. So if you have any questions, please let me know. This work is due on June 26th. Now, a quick little video, fairly simple, but just gives the basic definitions of risk and return.
Risk and return. Looking around us, we find that different financial products, such as fixed deposits, bonds, and shares, give different returns. Why do the returns differ? To answer this, we must first understand the idea of risk. An important principle of investment is higher returns entail higher risks. Risk drives the returns on assets. Fixed deposits earn the lowest returns because they are considered the safest. Shares have the highest expected returns as they are the most risky. Investment-grade bonds have expected returns lower than shares because they are less risky than shares. In investing, there is no reward without risk. If an investment offers higher expected returns, it will generally have higher risk. Suppose investment A has an expected return of 3%. If investment A performs better than expected, actual return will be above 3%. If it performs worse than expected, actual return will be below 3%. Actual return will be 3% only if investment A performs as expected. The presence of risk or volatility means that the expected return can differ from its actual return. The difference between actual and expected returns is risk or volatility. A simple statistical measure for risk is standard deviation. The larger the standard deviation, the greater the overall risk of an investment. Compare investments A and B, which have the same expected return of 3%. As B has a lower standard deviation than A, it will give a higher return to volatility ratio known as the Sharpe ratio. In investing, we aim to maximize the Sharpe ratio, which maximizes return for the same risk or minimizes risk for the same return. Further, to be successful in investing, you must understand your risk appetite. Assess your risk appetite on 3 dimensions: needs, ability, and willingness to take risk. If you plan to retire by 40, you would need to generate higher returns that will allow for early retirement. If you have dependents, your ability to take risk is likely to be lower than someone with no dependents. If you have the need and ability to take on risk, but find it unsettling after buying a risky stock, then willingness is low. You may want to consider investments with a lower risk profile, such as investment-grade bonds. Imagine investing as choosing a roller coaster ride. If you choose a wilder ride than you can handle, you are likely to want to get off the ride halfway, as it is scary when it dives. Similarly, if you have investments that are too risky for your risk appetite, you may panic and quit them prematurely when the market dives. The key to successful investing is the ability to stay invested. If you get off the roller coaster halfway, you could lose your investments. By staying invested, you may also ride out market volatility and business cycles. In the next video, find out more.
Okay, that recording or that video on risk and return took a look at it from the investor side of the house. But it gives some good definitions about if you're in financial management or corporate finance, that you have to satisfy the needs of the investment community in covering that risk in the performance of your assets. And one of these is called the cost of equity. This is what we're talking about in Chapter 6. What does it cost the company to provide an adequate return to their investors? If I'm going to look for some money in the capital markets and I go to the investment community and say, yeah, why don't you give me some capital and I'll give you some shares of stock in my company. And I say, we'll probably return 3% in the next year. Well, not too many people are going to be giving you their money. You have to promise or not tell them to expect to get a 7, 8, 9% return, depending on the market conditions and the economy. But you have to give them some type of assurance that you're going to provide them an adequate return on their investment. So that's what is called the cost of equity. And the cost of equity is a combination of risk in the market and the firm's business risk and the mix of debt and equity that they're using to finance their business. And that cost of equity is part of the overall cost of capital of a company. So the cost of equity is type of a investment return. What type of a return are you giving the investors in your business? Historically and into the future. And that return will be in dollars or most likely in percentages. Very simple example. Let's say an investment is $1,000 and over 1 year, $60 is earned off that investment. Then the investment return in a dollar is naturally $60 over the 1,000. And in a percentage, it's 6% return. Is that 6% or $60 adequate for the investor who gave you the $1,000? Does it support their desire for expectations from your business? Thus, the goal of financial management and corporate finance is to provide that adequate return to entice to get capital money in the equity of your business. And the investment risk is the exposure or the chance of that 6% not happening. The better the risk, the more opportunities people are going to invest in. But naturally, the higher the risk, the higher the return you have to give as a company, because you have to meet that risk of those investors. Risk is a major point in the determination of equity and capital investment. What is the risk of your company? And risk is a series of scenarios of what's the probability that you'll be given that return. Is it, in this case, 40% chance of getting a 6% return to your investors? And then other scenarios down the line. This risk probability is what makes up the calculation of beta. Beta is a risk analysis of your company's returns to the overall markets. And that probability distribution, the greater the likelihood that's happening, will be a lower risk. The less likelihood of that return happening means a greater risk. High risk means you don't reject the investment. You just got to make sure that that risk is covered. If I have a business right now and my business is in nuclear waste, that's a pretty risky business. So if people who are giving me money, either bank loans, bond loans, or investing in my stock, they're going to want that risk of being in the market that I'm in, nuclear waste, to be covered. So I'm going to have to probably make sure I make pretty high returns to them to cover those risks. and vice versa. If I'm in a pretty stable market, a stable industry with very little risk, then the pressure on my business to supply those higher returns is not needed. I can get away with providing 5% returns because there's less risk to the investor. Historical data is used to determine this risk, as I said, having to do with market, your relationship of your business in the company, about the standard deviation of comparing your average returns to the markets. And what's the market? Usually the S&P 500 index. And that's where we get into the capital asset pricing model. I think the textbook doesn't do a very good job explaining this, so I'm going to explain the capital asset pricing model, or the cost of equity, with a spreadsheet that I've prepared for today, and it's also included in your Blackboard. Here's our week 3 lecture notes spreadsheet for this class. And it covers a bunch of new topics, but I want to concentrate on one topic that's in the spreadsheet, and we'll get to the other areas later on in our class. But it's considered the cost of equity. What is the cost or the expectations of investors? Excuse me about the phone call. Shut up. There we go. What is the expected returns of investors who want to buy equity in your business? Now, that equity could be public equity, buying stock. It could be private equity, Shark Tank, hedge funds, venture capital. But they all want something in return. And that something in return is driven by market risk versus the risk of your business. And that's what the capital asset pricing model is all about in Chapter 6. The market risk is 2 areas. No risk or zero risk, which happens to be called the risk-free rate. That's the 10-year United States Treasury yield. If I go to borrow money and give my money $1,000 to the federal government in a 10-year bond, that's considered the risk-free interest rate. And an example here, it's 1.75%. And that's zero beta, no risk whatsoever. I have no chance of losing my money. Then you have what is called market average risk with a beta of 1.0. That's average risk. And that's usually the return in the S&P 500 or market return. And in this example, it's 8.5%. Look at the difference in the returns from zero beta, no risk, 1.75, and average risk, beta of 1, 8.5. Quite a spread. That spread between market return and the risk-free rate return is called the market premium. That difference, that spread between average risk and zero risk, it's called the market premium. That market premium is now compared in the capital asset pricing model to the specific risk of the company that you're looking at. And in this example, the company's beta is 1.5. Remember, beta is a standard deviation regression analysis, taking the return of your business, comparing it to the return of the market over 4 years, or four quarters a year. That's 16 quarters of return deviations between your company and the market. The more deviation, the greater the risk. Well, if the market return and the company's returns are matched, their beta will be 1. No change. The greater the risk or the deviation, the higher the beta. So let's take a look at this company here. We call it Company A. And we want to determine what is the cost of equity. What is the expectations of investors in the market, taking a look at this company in a market of zero risk, average risk, and the risk of the specific company. And the capital asset pricing model takes the risk-free rate, adds to that the market premium, times the beta of the company. And remember, the market premium is the difference between market return and the risk-free rate. So if I would do the arithmetic, it's 1.75 plus 8.5 minus 1.75, and then that number is multiplied by the beta of the company, 1.5. If I do that arithmetic, I get 11.88%, which makes sense. In the market now, risk-free is 1.75. Average risk is 8.5. And the risk of this company, which is 50% greater than the market risk, is 11.88, a lot higher. So if I wanted to buy stock in this company, I would be looking at, remember, every public corporation has to disclose on a quarterly basis their projections for return, profit, and the management of their revenues and business expenses for the next 12 months. And if a company comes out and says, yeah, we plan on returning and growing 12% in the next year, that would make this company's stock pretty attractive because they know that the risk of this company in the market is 11.88% return. But if a company is coming out of the pandemic or has a lot of competition in their business, and they can only maintain maybe 6, 7, 8% growth levels, then the demand for their stock would be rather poor in the market, because that, based on the risk of the company in conjunction with the risk in the market, the expectations are almost 12%. So the only way you would buy that stock is if it was very low in price. Welcome to the stock market. Supply and demand. If a company in the public and the market thinks a company can meet their expectations based on the risk and performance of their companies, their stock will be traded at a very nice price. The demand will equal the supply. But if the company is having a difficult time making money and there's high expectations for return, that price will drop until it gets cheap enough to warrant the investment in that price to get, in this case, 11.88% return. That's why this is a huge concept and definition in finance. Risk in relationship to return, and in your risk in relationship to the market, your customers, your competition, your government, and where you do business. All these play into being able to satisfy the investment community to get the assets you need to be competitive in your market. You need to meet and understand, as a financial manager, those risks and returns. The cost of equity calculation and the capital asset pricing model from Chapter 6 is a great way of gauging your company in the market. In subsequent weeks, we'll talk about the cost of debt. We combine the cost of debt with the cost of equity to determine the weighted average cost of capital. And I'm sure some of you have already studied that in your undergraduate courses. But in conjunction with Chapter 6, we're concerned about the relationship of where our business stands in relationship to the competitive markets of risk-free, average, and our particular company's risk, in this case, 1.5 in the market. We need to understand that concept and this formula to go further on in our discussions, because next week when we talk about Chapter 7 and bonds, Chapter 5, how does this calculations play into bond valuation? How does these calculations play into stock valuations? Are subjects of the next few weeks. So for this week number 3, I want you to make sure you understand the concept of risk and return, what the capital asset pricing model is and how to calculate that number. We'll be doing some of this work in the next few weeks. You have assignment 1, which is going over the basics of finance and financial management. And that'll give us a starting point to move forward into our additional assignments in assignment 2 and next week. We'll talk about risk and return and bonds and stocks in the upcoming week and weeks, and you'll be assessed accordingly. So thanks, everybody. Look for my weekend update video this coming weekend. If you have any questions on assignment 1 or this material, there's subsequent additional videos in Blackboard and in our YouTube playlist. Have a great week, everybody. Until next time, adios.